Hey Bay Area homeowners, you're probably not going to like me after this video.
You ready for prices to rise? New tariffs ordered by President Trump on Mexico, Canada, and China set to go in effect.
But I'm not here to coddle anyone's Zillow fantasies. You know those sky-high estimates? I'm here to tell you the truth about it's really like to sell a home in 2025 in this market and what's happening right now on the ground in the Bay Area. Hey guys, I'm Mac Rogers, a Bay Area real estate agent who's been riding this roller coaster long enough to know if we're clicking uphill and when we're about to drop. You know, I ride a lot of mountain bikes and I enjoy those rocky technical descents. But boy, right now, I'm gonna start to shit my pants. And I wanna share with you the cracks that I've been seeing. I've been getting a lot of calls lately like this. Hello, my house hasn't been selling. I think I need to fire my agent. Can you help me find someone better, or can I help them sell their house? While I do love to get those come list me calls, especially if they're looking at me as if the one that could help them save the day, I pretty much have an idea why their property is not selling. Listen, it's not always the agent. Sometimes it's the price, sometimes it's the presentation, and sometimes, I kind of hesitate to say this because it becomes a self-fulfilling prophecy, it's the market punching you in the face and saying you waited too long. So let's talk about what's really going on, because if your home isn't selling, it's probably one of these reasons or a mix of a few. These are the cracks I'm seeing in the Bay Area housing market right now. Crack number one, household debt is out of control. Across the United States, household debt has surged to unprecedented levels. By the end of 2024, total household debt reached a staggering 18 trillion, marking a 93 billion increase from the previous quarter. Credit card balances have notably risen with a 57% increase since early 2021, pushing the total to $1.2 trillion. This escalating debt isn't just a national issue. It's particularly acute here in the Bay Area. The region's exorbitant cost of living amplifies the financial strains on residents. For instance, in San Jose, a single adult needs an annual income of approximately $147,000 to live comfortably, while a family of four requires $371,000. With home prices routinely in the millions, the financial burden is even more pronounced. In April of 2024, the median home price in the Bay Area soared to $1.4 million, making home ownership increasingly unattainable for many. The combination of soaring debt levels and the Bay Area's high cost of living makes potential buyers more hesitant to commit to substantial mortgages. This caution contributes to a cooling housing market where properties linger longer and sellers face mounting challenges. Number two, commercial real estate is a disaster. This isn't just about San Francisco anymore. Yes, downtown San Francisco has office towers sitting half empty, but the ripple effects are spreading all over the Bay Area. Take San Ramon, for example. Bishop Ranch used to be a major office hub, home to companies like Chevron and AT&T. Now, they're tearing down office buildings to build over 8,000 homes. That's a massive shift. And if those new homes actually get built and meet some of the housing demand, guess what? It's going to put downward pressure on prices in the area. More supply usually means more competition, and in real estate, that often means lower prices, especially if demand doesn't keep up. And speaking of Chevron, they're not just downsizing, they're leaving. The oil giant is relocating its headquarters from San Ramon to Houston. That's not just a company moving offices, that's a lot of high-paying jobs gone. And those salaries supported local restaurants, dry cleaners, chiropractors, you name it. I've got a neighbor who owns a chiropractic practice in the city. Pre-pandemic, they were busy. Post-pandemic, they've never recovered. Still down more than 60% because so many of their clients were office workers who just aren't around anymore. The loss of that daily foot traffic isn't just a blow to business owners. It weakens the entire economic ecosystem that made these Bay Area cities thrive. Less local spending, fewer jobs, more uncertainty, and all of that bleeds into the residential market. Because let's face it, if people don't feel secure in their jobs or communities, they're not exactly racing to buy million-dollar homes. Crack number 3, inventory is up. Here's the thing, there's no one-size-fits-all in the Bay Area housing market. Each city, each neighborhood, even each street has its own story to tell. And depending on where you are, the slowdown might feel like a speed bump or a brick wall. In Silicon Valley, some neighborhoods are still hot. In San Jose, for example, homes are selling in just over 3 weeks on average, and multiple offers aren't uncommon, especially for move-in ready homes near major tech employers. But head out to the Delta or parts of eastern Contra Costa County, places like Brentwood, Aniol, Oakley, it's a different scene. Inventory is up, homes are sitting longer, and sellers are facing heavy competition, not just from each other, but from new construction communities offering rate buydowns, builder incentives, and move-in ready homes with warranties. That's tough to match for older resales. Even affluent cities like Danville and Alamo are feeling the shift. These markets used to move quickly, fueled by cash buyers and strong demand. But now, homes are lingering longer and price reductions are creeping in. It's not panic mode, but it's a wake-up call for sellers who expected their homes to fly off the market. The bottom line here, hyper-local matters more than ever. Don't assume that what's happening in one zip code applies to yours. What sells in Fremont might stall in Hayward. In Lafayette might still be holding firm, while in Walnut Creek, it might start to slow down. If you're selling, you need to know your market, not just the market. Number 4, buyers are tapped out. Let's not sugarcoat this. Buyers are stretched thin between rising living costs, student loans, credit card debts piling up. It now takes more than just a decent salary to buy a home in the Bay Area. You need 2 incomes, a side hustle, and probably a family member who's ready to give you a substantial amount of money. And that's before we even talk about mortgage rates. What's wild is how high the bar is, even in cities that people usually think of as more affordable. Look at Vallejo. The average home buyer there is pulling in almost $100,000 a year according to a recent data. That's not for San Francisco. That's not for Palo Alto. That's Vallejo. And the average buyer is still almost 50 years old. Not exactly your entry-level buyer. Now flip over to San Jose and the Silicon Valley corridor. The average income of a home buyer there is $1 million. That's right, $1 million. And the average age is just 41. That's startup founders, VCs, and execs, not your typical middle-class buyer trying to move up from a condo. Even in Santa Rosa, Petaluma, where you'd expect a more attainable lifestyle, home buyers still average $184,000 in income, and they're only 42 years old. That tells you everything you need to know about where the affordability line is right now. The reality is people know the math doesn't work anymore. They've run the numbers, they've played with the mortgage calculators, and they're hitting the brakes. It's not just about sticker shock. It's about long-term risk. They're asking, what happens if rates stay high? What happens if I lose my job? What happens if prices drop after I buy? And when buyers start thinking that way, they back out. Number 5, the rental market isn't your backup plan anymore. So maybe your home's not selling and you're thinking, no big deal, I'll just rent it out until the market gets better. Okay, but let's talk about that. Yes, rents in the Bay Area are still high compared to the rest of the country, but they've mostly flattened out. In some cities, they've even dropped slightly. With vacancy rates creeping up, you're not guaranteed a line out of your door of qualified tenants waiving their W-2s and perfect credit scores, if they still even have perfect credit scores. More new apartment buildings are coming online. More homeowners are thinking exactly like you. And in some cities, especially further out from the urban area, renters have options. If your home needs work, isn't updated, or is priced a little too high, it's going to sit just like it did on the resale market. And let's be real, if your plan is to rent it out until the market rebounds, you need to be prepared to hang on for at least 3 to 5 years, maybe longer, because market cycles don't snap back in 6 months. We're not in the 2021-2022 rocket ship anymore. So the big question is, Does that strategy actually work? If you can cover your mortgage comfortably, if you're okay being a landlord and dealing with repairs, vacancies, and tenant headaches, and if you're okay not accessing that equity for several years, then sure, it might work for you. But for a lot of homeowners, the math just doesn't pencil out. They're barely breaking even, or worse, they're floating the shortfall every month. And what happens if interest rates stay high longer than expected, or prices don't bounce back the way you hope? Now let's flip the coin, because for buyers thinking, I'll just rent until it crashes, be careful. Yes, it's cheaper than buying in many cases, but that doesn't mean renting is cheap. In San Francisco, the median rent for a two-bedroom apartment is still over $3,300 a month. In San Jose, it's around $3,200 a month. Even in Vallejo, you're looking at $2,300 to $2,600 a month for a decent house. That's a huge chunk of income, and it's all going to your landlord's equity, not yours. So while renting can buy you time, it's not exactly a financial refuge either. You're still paying a premium, just without the long-term upside. And if you're a homeowner banking on a rental to cover your mortgage, you'd better run the numbers and run them again. This is not the 2020 rental market anymore. Number 6, consumer spending is down. You know, when people start skipping $7 lattes, pausing their gym memberships, or trading in their Patagonia for Costco hoodies, you know we're in a different economic mood. We're seeing belt tightening across the board, and it's not just about inflation fatigue. It's about uncertainty. Whether it's tech layoffs, credit card debts piling up, or just plain burnout from the last few years, people are holding on to their wallets. And that mindset spills into real estate, because if buyers are hesitating to book vacations or upgrade their car, do you think they're rushing in to take on $1 million mortgage at 6.75? Not likely. Even folks who can afford to buy are pulling back. Not because they don't qualify, but because they're nervous. They're waiting, watching, and trying to time the market like it's the stock exchange. And in a market like this, hesitation kills deals. Number 7, economic uncertainty and the domino effect. You know that feeling when the first domino tips and you already know how the rest is going to fall? That's where we are right now with the economy. It starts with layoffs. Tech, biotech, retail, whether it's a headline about Google trimming staff or a local company quietly downsizing, it shakes people. Job security is the foundation for home buying. And when that foundation starts to wobble, everything else does too. Here's how this transpires. Layoffs hit. People freeze spending. Consumer confidence drops. Buyers get cold feet. Homes sit longer. Sellers start slashing prices. Market psychology shifts, but it doesn't stop the job cuts. We're also seeing ripple effects from global instability, trade tensions with China, uncertainty in the Middle East, tariffs on goods, supply chain disruptions. All of this contributes to a feeling of unpredictability. And when you're in that headspace, whether you're a first-time buyer or someone trading up, it's easy to hit the pause button. So while mortgage rates dominate the headlines, don't overlook this. Economic and global uncertainty is the silent killer of housing demand. It's the weight in the room. You don't always see it, but you feel it. And right now, a lot of buyers are feeling it and backing off. Crack number 8, consumer confidence is fragile and getting more fragile. We've already talked about layoffs, spending pullbacks, and global economic stress. But let's call this what it really is, a confidence crisis. Because all of those things, rising debt, shaky job security, headlines about rate hikes, inflation, wars, tariffs, they don't just affect bank accounts. They affect mindsets. And right now, a lot of people are in a wait-and-see mode. This isn't the kind of market where buyers are jumping in with FOMO. It's the opposite. They're hesitating, second-guessing, running the numbers over and over and over. And even if they come up with a good number, they're still not pulling the trigger. And it's not that they can't buy. It's that they're not sure if they should. And when consumer confidence wobbles, here's what happens. Fewer offers, longer days on the market, more price cuts, more buyers ghosting after tours, and way more sellers asking what the hell is going on. This is especially true in high-priced markets where people feel like they have more to lose. Talking about us here in the Bay Area. Even buyers who are well qualified, solid jobs, strong down payments are pressing pause until they feel more certainty. But here's the reality check. Markets don't wait for confidence to come back. By the time it feels safe again, prices and competition are already on the rise. So while consumer confidence may be soft right now, the smart move: stay informed and act decisively, not emotionally. Crack number 9, bond yields are creeping up and so are mortgage rates. Now, this one flies under the radar for most people, but it shouldn't. When bond yields go up, specifically the 10-year Treasury yield, mortgage rates usually follow. And when rates rise, buyers don't just lose confidence, they lose buying power. Here's how this plays out in the real world. Let's say you were pre-approved last year for 6% or 5.75%, and now rates are hovering closer to 7%. That 1-point jump can add hundreds of dollars to your monthly payment. Suddenly, that $1.2 million home you loved feels like 1.4 now, and you might not even qualify for it anymore. Buyers feel that, lenders feel that, and guess what? Sellers feel it when their open houses go quiet and offers dry up. Even if you're not following the 10-year Treasury on CNBC every morning, you're feeling the effects in the real estate market. Higher bond yields equals higher borrowing costs equals slower housing demand. Simple as that. And right now, bond yields are creeping towards levels we haven't consistently seen since the Great Recession. That's a big red flag. So the takeaway: if you're selling, price with precision. Don't assume buyers are stretching like they were 2 years ago, because their money simply doesn't go as far. Crack number 10, first-time buyers have left the chat room. Let's talk about the buyer that fuels the whole market engine, the first-timer. And right now, a lot of them, they've checked out. Affordability is the obvious challenge. Between high home prices, rising mortgage rates, and crushing debt, many would-be buyers just can't make the numbers work. Even with decent jobs, they're getting squeezed out of the Bay Area starter home market. But it's not just about can't, it's also about won't. A lot of first-time buyers are simply choosing not to engage right now. They're renting longer even if it's not ideal. They're moving to more affordable inland cities or out of state. Say hello Sacramento, Reno, or Austin. Or sitting on the sidelines waiting for a crash that may never happen. And here's why that matters. First-time buyers unlock the chain. When they buy their first home, that seller moves up. Then that seller moves up again. Take them out of the equation, the whole system clogs up. So even if you're not selling a starter home, this still affects you. Fewer first-time home buyers means fewer move-up buyers down the line. That ripple travels all the way up to the luxury market. Right now, the demand just isn't flowing like it used to. And until confidence and affordability return for that first-time homebuyer segment, don't expect a rush of new buyers flooding into your listing. Okay, here's a bonus. Let's talk about expectations. If your strategy is to price high and wait, you might be in for a disappointment. Homes with outdated features or in need of repairs are less appealing to today's discerning buyers. To sell in this market, you need to either make your home stand out with updates and staging, and also price it competitively to reflect its condition. Hey, if this resonated with you, please take the time to subscribe and click the like button. Reach out and let's discuss a realistic strategy to sell your home in today's market. Together, we can determine your home's true value and create a plan that aligns with the current market conditions. One last reality check. Don't be swayed by agents who promise unrealistic outcomes just to secure your listing. Choose someone who provides honest assessments and practical strategies. The market is evolving rapidly, and staying informed is key to a successful sale. Remember, understanding the current market dynamics is crucial. By setting realistic expectations and being proactive, you can navigate the challenges and successfully sell your Bay Area home in 2025. Thanks for watching.